So let's talk about a chemical giant that's really up against the wall. We're looking at LyondellBasell. They are smack in the middle of a historic industry downturn, and it's forcing them into a massive, radical transformation. Now, if you're an investor, this is the definition of a high-stakes bet. It's a race to see if they can pull off a huge turnaround before their finances completely buckle under the pressure. All right, let's get into it.
And look, if you want to understand just how serious this is, this quote says it all. In early 2025, the company's own CEO put it out there, plain and simple. This isn't just some rough quarter. We're talking about a full-blown crisis that is testing the absolute limits of the entire industry. And LyondellBasell, they're right in the eye of the storm.
To really get what's happening with the company, you've got to understand the bigger picture. LyondellBasell is caught in what you can only call a perfect storm for the entire global chemical industry.
So what exactly is in this perfect storm? Well, it's a few things all hitting at once. First off, there's been a huge wave of new production, mostly out of China, that's created this massive global glut of supply. Then you've got high inflation and interest rates just crushing demand for all the plastics and chemicals that go into, everything from cars to houses. And on top of all that, there's this long-term pressure for sustainability, this global push to get away from single-use plastics, which is forcing them to rethink their whole business. The result of all this? The absolute worst profit margins the industry has seen in over 10 years.
Okay, but here's the thing you really need to get about this industry. It all comes down to something called feedstock economics. It's actually pretty simple. In North America, producers use ethane as their main ingredient, and it's super cheap because it's a byproduct of shale gas. But in Europe and Asia, they mostly use something called naphtha, which comes from crude oil and is way, way more expensive. This cost difference, it's literally the biggest competitive advantage in the business. It pretty much means that in the world of chemicals, geography is destiny.
And this chart, well, this is where the rubber meets the road for LyondellBasell's big problem. You see, almost half their business is in the US, where they have that cost advantage. But look at that other big slice, almost 20% from Europe. That means a huge piece of their company is operating on the wrong side of that critical cost divide, making them structurally uncompetitive. That European exposure is the real source of their pain right now.
So, faced with this crisis, what's management doing? Well, they're not just sitting around waiting for things to get better. Nope. They've launched a radical strategic pivot, a plan designed to completely reshape the company from the ground up.
So their game plan, it's basically built on three big ideas. First, grow and upgrade the core. That's a nice way of saying they're going to sell off those struggling European assets and double down on their profitable US operations. Second, they're building a whole new business around recycling and sustainable chemicals. That's their new growth engine. And third, they are going on an all-out cost-cutting blitz to make the whole organization leaner and meaner.
And they're not just talking a big game here, they've put a huge number on that new growth engine. The goal is to be making an extra $1 billion a year in EBITDA from this new circular and low-carbon business by 2030. So what's the key takeaway here? This isn't just some vague promise. It's a concrete plan to swap out old, unpredictable earnings with a new, hopefully much more profitable, stream of income.
Now, the other side of this is all about playing defense, hardcore defense. Management is aiming to find $1.1 billion in cash improvements by the end of 2026. This isn't about growing the company. This is about survival. It's about generating enough cash to weather this storm and actually pay for this massive strategic pivot.
But here's the catch. A plan this big, it needs one thing they might be short on: time. And this right here is where the real drama starts for any investor. The company is walking a financial tightrope, and it's a race against the clock.
This is it. This is the single most important question you have to ask yourself as an investor right now. The strategy sounds good, right? But can the company's bank account actually handle the pressure of this downturn long enough to make it to the other side? Let's look at the numbers.
Whoa, okay, just look at this. This chart tells you everything you need to know about how tight things are. Their main debt level is sitting at 4.47 times their earnings, and the absolute maximum their lenders will allow, 4.5 times. They have basically zero room for error. They are pushed right up against the ceiling of their debt covenants, which are just the rules their bankers set. If earnings slip even a tiny bit more, they could break those rules, which could let the banks demand all their money back immediately.
And it's not just us seeing this, right? The big credit rating agencies, S&P and Moody's, they are sounding the alarm. Both have put the company on a negative outlook. That's basically a formal warning shot saying that their prized investment-grade credit rating is in serious danger of being downgraded to junk status.
And if that happens, borrowing money gets a lot more expensive, and it could force them to take some really drastic measures. So what do you do when the pressure is this intense? You start making tough choices. It's like financial triage. You can see it right here. In the first part of 2025, they were still doing stock buybacks and paying dividends. But by the third quarter, the buybacks got shut down completely. They're sacrificing one way of giving money to shareholders to save cash for what they see as more important, paying their debt, and, for now, keeping that dividend alive. And that brings us to the dividend, a yield of over 12%. I mean, that's just wild, and it perfectly captures the two sides of the story. If you're a bull, that's an incredible paycheck you get while you wait for the turnaround. But if you're a bear, well, that huge number isn't a reward. It's a giant red flag screaming that the market thinks a dividend cut is not just possible, but likely. All right, so after all that, we land on the multi-million-dollar question for anyone looking at this stock. When you put the ambitious turnaround plan on one side of the scale and the massive financial risk on the other, what's the final call? Is this thing a massive value play or a classic value trap?
So let's break it down. On one hand, you have the bull case. The industry finally starts to recover in 2026, the big strategic plan actually works, the balance sheet doesn't break, and you get to cash those huge dividend checks. Simple enough. But the bear case is just as compelling. This downturn isn't a cycle, it's a permanent change. The company starts burning through cash even faster, its credit rating gets chopped to junk, and that juicy dividend disappears.
Okay, so if you're going to follow this story, here's your personal watch list. These are the things you absolutely need to keep an eye on. Number 1, cash from operations. That is the lifeblood of this company right now. Then, any news from S&P or Moody's. You'll want to watch for any progress reports on selling those European assets. And keep an eye on that ethane versus naphtha price spread. That tells you how healthy their main U.S. business is. And of course, every quarter you'll be waiting to see if they declare that dividend again.
So, at the end of the day, it really boils down to this, doesn't it? Is this a golden opportunity to buy a fantastic company at the absolute bottom, right before it reinvents itself? Or are the financial risks just too big, making that tempting 12% yield nothing more than bait for a classic value trap? The answer is going to play out, for better or for worse, over the next few quarters.